Valuation, they are regularly arranging such type of programs. So apart from actually our usual requirement for a CEP hours as per regulatory provision, this type of program will also provide us an opportunity to share our knowledge with each other, to actually upgrade our knowledge. After all, we all are experienced professional. So these type of programs will certainly provide us opportunity to share our knowledge with each other. So today's topic, as Kajal Madam informed, the statutory and regulatory guideline as per the statutory provision, various regulation. So last week, last Sunday, those of you who have actually attended, so we had covered the guidance provided under the valuation standard. So that was principle based. So as we all are aware, the principle based and a rule based guidelines on evaluation. So last week we covered the principle based guidelines on valuation, and today we are going to cover the rule based guidelines on evaluation. So you will appreciate that coverage of this will be very actually wide, and probably if we discuss the provisions under Income Tax Act itself, so 2 hours will not be sufficient. So given that limitation, I will try to give as much input as feasible, and without actually devoting any further time on introduction, I would like to share my PPT. So just allow me 1 minute. So I hope my PPT is visible to each one of you. If you face any issues in visibility of my PPT, please inform me anytime. And my sincere request again, please make this session as a knowledge sharing and interactive session, which will be in the mutual interest of all of us. So valuation guidelines from a statutory and a regulatory provision with landmark judgment on evaluation. So this will be the coverage, proposed coverage. So we will cover certain aspect brief about valuation under IBC. As we all are aware, IBC is responsible for recognition of the concept of a Companies Act. Uh, 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 means that happened only after introduction of IBC, the concept of registered valuer that was recognized under the provisions of the Companies Act. So that is the prime legislation, valuation under IBC and IBBI regulation. We will also cover brief about the valuation under Companies Act. So as we all are aware, the concept of registered valuer that is recognized under Section 247 or Chapter 17 of the Companies Act. So these two are a very important legislation as far as the concept of a registered valuer is concerned. Then we are going to cover the valuation under SEBI regulation. So as we all are aware, SEBI regulations are applicable to the listed entity, and a company's rules are applicable to the unlisted entity or private company as far as valuation is concerned. Then a valuation guideline under FEMA. So wherever actually transaction with a foreign companies are involved, so that is we are going to cover that in brief. And a valuation under IT Act, very important. And then we will cover a few landmark judgment on the valuation. So this will be the coverage of our today's topic. Now, why we need the evaluation? Why we need the valuation? So basically, we can divide it in three buckets. Number one, a regulatory requirement, a requirement under statutory law or a regulation or a rules. Then we have certain transaction for which we will need the valuation, and for the purpose of financial reporting, for the purpose of accounting, we need the evaluation. So regulatory, we have already covered Companies Act provision, IBC, SEBI regulation, RBI and FEMA regulation, income tax and other litigation matter. Transaction, major transaction will be related to merger and acquisition. So in merger and acquisition, right from negotiation until actually completion of the deal, and finally a reporting of the asset acquired in the books of acquirer, we need the valuation at each stage. Then a fundraising and investment decision. So the valuation will play very critical role, very crucial role. Sale of business, similarly, and voluntary assessment. Sometimes the progressive management of the company, they actually regularly assess the valuation of their business enterprise. So in that valuation will be needed. And accounting purpose, a fair reporting. As we all are aware, IFRS 13 or Ind AS 113, which are on measurement of fair value. And there are many transactions which need to be reported at fair value in the financial reporting, financial statement. Then a purchase price allocation, as we all are aware, this is required at the time of acquisition of the assets or a business. So that actually will allocate the assets, or for the purpose of reporting the acquired assets and a liability in the books of acquirer, we need to determine the fair value, because in majority of the M&A transaction, mergers and acquisition transaction, we need actually lump sum consideration. So those transactions are accomplished or completed at lump sum consideration. So for the purpose of financial reporting, we will need the measurement of fair value. Employee stock option valuation, we all are aware, okay, another complex issue. And then impairment testing, which is required from time to time, and portfolio value investment. So all these are actually the need for evaluation. Now, actually, as we all are aware, the concept of registered valuer, that is not recognized across all the law. As we all are aware, valuation bill to 2020 that was introduced in the parliament, but now actually the tenure of present Lok Sabha, that is on the verge of completion. So I think now there are slim chances that valuation bill will be passed by the present Lok Sabha. And once it is not done, so that will lapse and that will be left to the new government. But in Valuation Bill 2020, as we all are aware, there was proposal for creation of a common regulatory authority for the profession of valuation, but that actually will be left to the new government. So if we actually analyze the current provision, so under IBC, as we all are aware, and regulation made there under, so IB valuation need to be done under all the provision by the IBBI registered valuer as per the provisions of Companies Act and rules made there under. So again, it is IBBI a registered valuer as per Ind AS. So actually the concept of Indian Accounting Standard or Ind AS, that is recognized under the Companies Act 2013. So therefore, actually, wherever a valuation is required under Ind AS, Indian Accounting Standard, for the purpose of financial reporting, so there again a valuation is done by the registered valuer. And a SEBI regulation, SEBI regulation at few places, the concept of registered valuer is recognized. As we all are aware, last it was recognized under the AIF regulation, alternate investment fund regulation. And apart from that, under SEBI regulation, at some places valuation is required by the charter accountant, at a few other places it is required by the merchant banker. Income Tax Act and rules made there under, so CA and merchant banker, they are authorized to do the valuation. FEMA, either that is CA, cost accountant, or a merchant banker. So you will appreciate from this highlight that actually the concept of registered valuer, that is not recognized uniformly under all the law provision, and different law provision have a different requirement for evaluation by a professional. So that is actually the diverse statutory framework about authorized evaluation professional. Now we will start with the IBBI regulation. As we all are aware, IBBI, that is a IBC, Insolvency and Bankruptcy Code, that is a process-driven code. So there are many processes, multiple processes, and each of those processes will need the evaluation. So we have the CIRP, Corporate Insolvency Resolution Process, Fast Track Insolvency Resolution Process, PPIRP, that is pre-package insolvency resolution process. Then we have the liquidation, a voluntary liquidation process, bankruptcy for personal guarantor to the corporate debtor. So under all that, actually, a valuation is needed. But what we are going to cover, we are mainly going to cover the CIRP process and liquidation process, because in other processes, the requirement of valuation that is identical, that will remain almost same. So as we all are aware, as per the guidance provided under IBBI CIRP regulation, the two registered valuer are appointed to determine the fair value and liquidation value as on the date of ICD, that is insolvency commencement date. So that and under liquidation process regulation, the valuers are appointed to determine the realizable value. So this is the requirement under CIRP. Valuer need to ascertain the fair value and liquidation value, whereas under liquidation process regulation, valuer are appointed to determine or to measure the realizable value. Now, whether whatever guidance is provided under the regulation, whether any scope is there for a review or improvement. So I have highlighted certain area which actually are crucial and that may require review and improvement. As we all are aware, IBC is a evolving law. So time to time, many changes are taking place. So in the field of valuation, I have highlighted certain issues. So we will start with asset class wise valuation under CIR. So as we all are aware, as per the guidance provided in IBBI regulation, as well as under the company's registered valuer and valuation rule, asset class wise valuation is mandatory. Asset class wise valuation, that is land and building, separate valuers are appointed. Plant and machinery, separate valuers are appointed. And for SFA or securities and financial asset, separate valuers are appointed. So in short, wherever there is a requirement or wherever a corporate debtor who is under CIRP, if he is having all three types of asset, plant and machinery, land and building, and SFA. So in all, actually, the IRP or RP, resolution professional, he is supposed to appoint 6 RV, two each for each asset class. So that is the statutory provision, that is the regulatory provision. Now, actually, what is the purpose of CIRP? What is the ultimate objective of CIRP? What is the aim of a CIRP? What will measure a success of CIRP? So that is actually the ownership transfer. Under a CIRP, the resolution of insolvency, that is accomplished through ownership transfer. Now, when we are talking about ownership transfer, so that will involve a transfer of entire enterprise, entire company, or entire business of the corporate debtor. So, keeping that perspective in mind, whether it is proper to actually do the asset class wise valuation. So we will understand that with a simple personal example. Supposing I am having a two-story building, ground floor, first floor, and second floor, and my intention is to sell that entire building as one unit to one buyer only. So that is my intention. Now, in that perspective, in that scenario, if I need to estimate the value of my residential building, so whether that will be proper to do the evaluation separately for each floor. That is separate valuer for ground floor, separate valuer for first floor, and separate valuer for second floor. And then I will add the valuation estimate given by all the three to arrive at the composite value of my entire residential unit. So whether that is appropriate. And in that question will arise, who will actually take the value of land? Because building, as you all are aware, that can be constructed on a plot of land. So how the value of land will be considered by a different set of valuer. So how actually ground floor valuer will consider, because each valuer will have their own independent judgment about the value of land. So you all will agree that is not the proper situation, that is not appropriate, because my ultimate intention is to sell entire residential building as one unit. So same thing is with the CIRP process. In a CIRP, the ultimate intention is to sell the entire business, entire enterprise of the corporate debtor as a going concern. So in that, when we are appointing a six valuer, two each for asset class, so who will consider the going concern value? Going concern value. You will agree that the going concern value of entire business, that will be more as compared to separate set of valuation for each asset class. If I dispose of land and building separately, plant and machinery separately, SFA separately, so that will actually realize less value as compared to when I am selling entire business as a going concern to one buyer. So that is actually number one, which we need to consider as valuer. We should have actually other, because now, as you all are aware, CIRP regulation, those have been amended in the recent past, and in that actually the registered valuer are required to give actually plan or their methodology before the committee of creditor. And if six registered valuer, they give a methodology before the COC, naturally this question will arise, how actually the going concern value is considered by the registered valuer. And that is, according to me, substantial part of the entire evaluation estimation. So that is question number one, the asset class wise evaluation, and why it is required. So in that I will highlight this. So actually, as you can see, the two registered valuer appointed under Rule 27. So this is Regulation 35 of the CIRP regulation. So two registered valuer appointed under a Regulation 27 shall submit to the RP an estimate of the fair value and of the liquidation value computed in accordance with the internationally accepted valuation standard after a physical verification of inventory, a very important physical verification of the assets and inventory of the corporate debtor. Many times it has happened that a valuer has done the valuation in the absence of a physical inspection of the assets of the corporate debtor, and the disciplinary committee of the IPPI or authority, they have issued a stricture, they have issued the disciplinary orders against the concerned registered valuer. So a physical verification of the inventory and assets of the corporate debtor, that is a very important. And a relevant is to estimate of value in an asset class. So here, as you can see, the stress is on in an asset class. And if you go to the explanation, which is appended to this regulation 35, so asset class means the definition provided under a company's registered valuer and evaluation rule. And if you refer to the definition of asset class under the rule 21C, clause C of sub rule 1 of rule 2 of company's registered valuer and valuation rule. So asset class means a distinct group of asset like land and building, machinery and equipment, displaying a similar characteristic that can be classified and requires a separate set of valuer for evaluation. So it is a very clear that actually asset class wise valuation is required as per the IBBI CIRP regulation. So that is law of the land. Once that is part of the regulation, we do not have other alternative but to do the valuation going by the guidance provided in the regulation. But at the same time, whether that is proper and how actually the going concern value will be considered by all six registered valuer.
Hello,
Kajal
I'm
madam.
guys. Oh.
Kajal madam. मैडम काजल
Yes, sir.
प्लीज कोई आवाज नहीं आ रही जरा
Yeah,
देखना
there's a yes, sir. There's a network issue from his side. I'm just checking.
We can hear you, sir.
So I am sorry, there was some a technical issue. It never happens from my side. I am having very high speed internet connection. But after all, that is technology. Sometime actually we face the issue. So again, I will share my PPT. Before going to break, I was emphasizing whether actually the asset class wise evaluation under the CIRP regulation, whether that is require a certain review or not. So that is number one. Now, a meaning of realizable value. So as you all are aware, realizable value, that is a basis of value. That is standard of value. So a basis of value or a standard of value, that is very important consideration in the entire evaluation estimation. We all know the importance of foundation structure in a building. So if a foundation is strong, entire building will be strong. So same way, if we have selected a correct basis of value or standard of value, so that will provide a strength to the entire valuation estimation. So a realizable value, that is actually the basis of value, standard of value. Now, if you refer to the international valuation standard or the ICAI, that is Institute of Chartered Accountant of India Valuation Standard, or the IBBI regulation, any of the IBBI regulation, the meaning of realizable value, that is not clarified anywhere. That is not clarified anywhere. As we discussed, under a CIRP regulation, the valuer determine the fair value and liquidation value. So if you refer to IBBI CIRP regulation, and more particularly regulation 2, so you will get the meaning of fair value or meaning of liquidation value. So that is provided under the CIRP regulation itself. But realizable value, which need to be determined under the liquidation process regulation, meaning of that is not provided in the liquidation process regulation and the international valuation standard or IVS. So when actually meaning of such a important terminology is not provided anywhere, so naturally each valuer will go by his own judgment, and that will actually a possible cause for a different valuation by the different valuer. Now, if I give one example of how we can interpret the realizable value differently, so when actually company has gone into a liquidation, so naturally in a majority of the cases, it may happen that assets of the company that is not actually in operational condition, that has remained inoperative for a very long duration, plant and machinery and all. So actually, one valuer, he will determine the value of those machinery to bring it that to the operating condition. So in that, what cost is involved, so that will be reduced from the estimated value, and similarly, the cost of disposal of the plant and machinery, that will also be reduced from the gross realizable value. So that is one way of arriving at the realizable value. Other actually valuer may have a different interpretation about the realizable value. So what I am highlighting here is actually meaning of such a important terminology that needs to be clarified under the regulation. If you refer to IVS 104, which is on basis of value and premise of value. So there are six basis of value or standard of value. These are actually provided, and none of these six basis of value is related to realizable value. So very important, actually, we need to actually understand the meaning of realizable value. Number 3, exact standard, which is standard of value referred to by the term of fair value under a CIRP regulation. So as we have actually discussed, the registered valuer under a CIRP process are appointed to determine the fair value of the assets of the corporate debtor. Now, actually, what is the meaning of fair value that is provided under Regulation 21 HB? So, Clause HB of Sub-Regulation 1 of Regulation 2. So, fair value, that means the estimated realizable value of the assets of the corporate debtor if they were to be exchanged on the insolvency commencement date between a willing buyer and a willing seller in arm's length transaction after a proper marketing where the parties had acted knowledgeably, prudently, and without compulsion. So that is the meaning of fair value which is provided. Now, actually, as we all are aware, particularly those of
Hello.
you who are from finance background, any questions?
Yes, sir. Can you please repeat the realizable value with a proper example?
So a realizable value, actually, as I informed you, the under the liquidation process regulation, the registered valuer are appointed to determine the realizable value. Now, since you have asked this question, I will skip and go here. So let me take you to the relevant slide so that so here actually this is the regulation 32 of IBBI liquidation process regulation, sale of asset. So a liquidator under liquidation process regulation has this six scenario, six situation under which he can dispose of the assets of the corporate debtor. So number one, asset on a standalone basis. Number two, assets in a slump sale. Number three, a set of asset collectively. Number four, assets in parcel. Number five, corporate debtor as a going concern. And number six, the business of the corporate debtor as a going concern. So these are the six situation, six scenario. So the scope of valuation under a liquidation process regulation, that is much wider as compared to a CIRP. Because in a CIRP, valuers are appointed simply to determine the fair value and liquidation value of the assets of the corporate debtor on ICD insolvency commencement date. So here there are six situations. So in all, actually, six valuation estimation will be required. Now, if you go through this particular provision, actually, I will take you there. Just give me a minute. This is relevant. You can see my highlighted portion. So registered valuer appointed under sub-regulation 2. So this is regulation 35 of IBBI liquidation regulation. So shall independently submit to the liquidator the estimates of realizable value. Estimates of the realizable value. Now, if you actually understand the meaning of realizable value, so in case of when we are determining value of an enterprise, so what we determine, we determine the enterprise value of a business, or what we determine is the value estimate as per market income, a market approach, or as per the DCF, that is discounted a cash flow method. So how you will determine a realizable value? Because in a DCF, what you are measuring, that is the intrinsic value of equity. That is not the realizable value. Realizable value, as I informed you, supposing actually if we take the example of a plant and machinery, even we can take simple example, supposing I am having a additional house, surplus house, and that house building, residential building, that has remained unused, that was vacant condition for a period of say 2 years. Now, after 2 years, since that is additional residential building, I intend to sell that. Now, naturally, since this building has remained vacant for 2 years, I will actually do the whitewash of that. I will carry out certain minor repair of that. So that will involve cost. So, and plus the disposal of residential building, that will also involve certain cost, the brokerage and all. So actually, when I am determining the realizable value, so one valuer may actually supposing a gross realizable value of that house is 1 crore. So one valuer can give the realizable value as it is 1 crore. Another valuer actually may reduce the value which is required to bring that house to sellable condition. Supposing whitewash and all that I spent 5 lakh rupees, and for a brokerage and all I have spent 2 lakh rupees. So another valuer, what he will do, he will reduce this 7 lakh from the gross 1 crore rupees and determine the realizable value at 93 crore. So both are correct. Both valuers are correct. Both actually 0.93 crore. So, or 93 lakh. So both actually are correct in their point of view, since the meaning of realizable value is nowhere provided under the IBBI regulation or under the valuation standard. So that is what I highlighted. So do you have any further question to that? I hope I explained.
Yes, sir, it is okay.
Yeah. Okay. So that is what I highlighted. Now we will go where we left. Now, actually, the fair value, as those of you who are from finance background, we determine the fair value for the purpose of financial reporting. For the purpose of financial reporting. So, IFRS 13 or Ind AS 113, these are based for a measurement of the fair value. So fair value under these accounting standard, that is purely for the purpose of financial reporting. Now, what is the purpose of CIRP? That is ownership transfer. So in ownership transfer, what we need to determine is the market value of the assets of the corporate debtor and not the fair value. So in that context, I have highlighted the meaning of fair value, which is provided under IVS 104. So if you refer to para 30.1 of IVS 104, you will get the meaning of market value. So market value, that is the estimated amount for which an asset or a liability should exchange. Now here, as you can see in valuation standard, the terminology used is estimated value, not the here it says estimated realizable value. So both of these is having a different meaning. We can take this in a different context. So very important to understand what you are actually determining. Number one, that is the market value, not fair value. Number two, you are determining the estimated amount, not the estimated realizable value. So estimated amount for which an asset or liability should exchange on the valuation date. Here it is ICD, insolvency commencement date. Here it is valuation date. So between a willing buyer and a willing seller in arm's length transaction. Arm's length transaction means transaction between two unrelated parties. So you cannot consider transaction between a related party in this. So arm's length transaction after proper marketing and where the parties had each acted knowledgeably, prudently, and without compulsion. Now we have less time. Otherwise, I would have gone through entire this. Whatever I have highlighted in bold, you will get meaning of that in IVS 104. What is the meaning of estimated value? What is the meaning of exchange on the valuation date? What is the meaning of willing buyer? What is the meaning of willing seller? So all that meanings are clarified under the IVS 104 in a detailed manner. So I will suggest for your academic interest, if you have not gone through that, you can go through that to better understand this perspective. So here, what I have highlighted, what I am trying to highlight, in effect, what we determine during a CIRP is the market value, not the fair value, because that is logical also. Ultimate purpose of a CIRP, that is the ownership transfer. Now you will say what difference it will make. So in that, actually, I am highlighting this a meaning of fair value, which is provided under IFRS 13, and a same meaning is provided under Ind AS 113. So IVS 13 defines the fair value as the price. Here, see, it is price. Here it is not value. So there is a difference between price and value. So as the price that would be received to sell an asset, or a paid to transfer a liability in orderly transaction between market participant or at the measurement date. So here, actually, received to sell an asset. So that is exit price. That is not the entry price. Received to sell. It is not a payment paid for a purchase. Received to sell. That is your exit price, not the purchase price. So price in the market, you will appreciate that will always be determined based on the based on the forces of or factors of supply and demand, that will be determined by the market participant. Whereas the value, as we all are aware, that will have a totally different consideration. So actually, that also a need consideration. Exact standard of value are referred to by the term fair value under the CIRP. So in effect, what we are determining, that is the market value and not the fair value. Now, actually, if you go to this again, I will take you to the liquidation process regulation. And here, actually, it says, as you can see, realizable value of the assets or a business, as the case may be, computed in accordance with company's registered valuer and valuation rule 2017. So only in a liquidation process regulation, it says the evaluation need to be done going by the provisions of the company's registered valuer and valuation rule. In all other regulation, so if you go through the CIRP regulation, so here it says as per the international financial reporting standard. As you can see, this value computed in accordance with the internationally accepted valuation standard. Internationally accepted valuation standard. So that is the guidance in all other regulation, like fast track insolvency resolution process regulation, the pre-package insolvency resolution process regulation, bankruptcy means regulation for a personal guarantor to corporate debtor. So everywhere it is the international valuation standard, internationally accepted valuation standard. It is IVS. But in liquidation process regulation only, they actually there is a need to determine the going by the company's registered valuer and valuation rule. So a question will come, what is the difference here if we go by company's registered? So as you all are aware, at present there are 15 RVO. 15 RVO which are recognized, registered valuer organization, which are recognized in India. And majority of these 15 RVO, including the Divyajyot Valuation Foundation, they go by the IVS, International Valuation Standard. But ICAI RVO, as we all are aware, they follow the actually companies, they follow the ICAI evaluation standard, valuation standard notified by the Institute of Chartered Accountant of India. So these two are a different standard. Now, actually, if you visualize a situation where actually a two registered valuer are appointed under the liquidation process regulation, and one is the member of ICAI RVO, another is member of, say, Divya Jyot Valuation Foundation RVO. So one will follow the international valuation standard, another will follow the ICAI valuation standard. So naturally, that will result in a different estimate of valuation, different estimate of valuation. So there is a need actually to bring the uniformity. There is a need to bring the uniformity in the valuation. So that is guidance of use of IBS across all IBBI regulation. That is the need of the hour. So these are the point: asset class wise valuation under the CIRP, whether that is proper. So in that context, I would actually again like to bring here. So liquidator has more liberty. Liquidator actually can do the valuation under a six scenario. You will say what is the provision for that? So that is regulation 32A. Regulation 32A. So actually here it is highlighted for the purpose of sale under sub-regulation 1, the group of asset and liability of the corporate debtor as identified by the committee of creditor under sub-regulation 2 of regulation 39 of IBBI CIRP regulation shall be sold as a going concern. So that is number one. So there is a provision to sell as a going concern. Going concern means all the asset together, land and building, plant and machinery, and SFA. And actually here it's a where actually the COC has not identified the assets and liability under sub-regulation 2 of regulation 39C. So actually the liquidator shall identify and group the assets and liability to be sold as a going concern in consultation with the consultation committee. And if the liquidator is unable to sell the corporate debtor or its business under clause E or F of the sub-regulation 12 within 90 days, so he shall proceed to sell the assets of the corporate debtor under clause A to D of sub-regulation. So here are the clause A to F of the regulation 32. So under liquidation, either actually assets can be sold on a standalone basis or actually in a slump sale. Slump sale, what is the meaning of slump sale? That we can get from the Income Tax Act. Actually, nowhere under the IBBI regulation or nowhere under the international valuation standard you will get the meaning of slum sale. But at least in Income Tax Act, what is slum sale? That is prescribed. Then a set of asset collectively, assets in parcel, corporate debtor is a going concern, and a businesses of the corporate debtor is a going concern. So there are six situations, six alternatives, six different scenario under which the liquidator can sell the asset, but same liberty is not there with the RP, that is resolution professional, although the RP is expected to transfer the business of the corporate debtor as a going concern. So I hope actually whatever we covered under these IBC regulation, that is useful. And what I have done here, I have provided a summary of provisions concerning the valuation under IBC. So section 59 of IBC, as we all are aware, section 59 is for voluntary liquidation. So under a voluntary liquidation, a valuation of assets of a company will be required. Then regulation 3 of IBBI, a voluntary liquidation process regulation. Then actually section 46(2) of IBC, undervalued, as we all are aware, preferential transaction, that is very important. So this section 46(2) of the IBC, that is relating to the undervalued transaction. So how actually how the RP, that is resolution professional, will determine that transaction is undervalued. So that will be based on the valuation report submitted by the registered valuer. So that is 46(2), and this regulation 26 of the fast track insolvency resolution process. So there actually a fair value and liquidation value measurement is required. But here only one registered valuer will be required instead of two. And then we have the pre-packaged insolvency resolution process. So again, two registered valuers are appointed. Then we have this so these are the provisions under the IBC. Majorly, these are the provision under IBC where the valuation will be required. So with that, we will complete the IBC portion, and then we will go to a Companies Act. So in a Companies Act, actually where valuation is required, that I have highlighted. Number one, it is section 192(2). So subsection 2 of section 192. So that is relating to non-case transaction involving the directors. Non-case transaction means transaction taking place in kind. So there actually a requirement to value the assets, whatever is the part of that consideration or whatever that part of that transaction. So a valuation by the registered valuer will be required. Then
Sir,
we have this.
could you please
Yeah,
explain the, yeah, may I disturb you?
yeah, no issue, sir. Anytime.
Yeah, could you please explain once again the going concern, the terminology?
Okay, so a going concern. So actually, I gave you the example also, going concern.
Is it
You
mean
are,
that, yeah,
yeah. So what actually each business, supposing I am running a business for 10 years. So in
mm,
10 years, I will earn the goodwill. I will earn certain reputation. I will earn a certain brand image for the company. I will earn a loyalty of the customer. I will earn a reliability of my supplier. So all that consideration which are not tangible in nature, those are intangible. That will be a part of the intangible value, or that will be the part of going concern value. All those intangible consideration will be part of going concern value. So that going concern value, and you have the experienced staff also. Supposing actually when a business is going concern, so you will have actually procedure set for them, machinery in working condition. So that, all that actually will fetch more value as compared to when you are selling only land and building separately, furniture and fixture separately,
so
plant and
basically you
machinery
mean,
separately. Yeah, go ahead, sir.
so basically you mean that the company is running.
Yes,
Yeah.
because many cases, because what is CIRP? Ownership transfer, the resolution of insolvency, that is through ownership transfer. So when we are making ownership transfer, so whenever actually the business of the corporate debtor is in operating condition, when
Mm.
actually it is taken over by the IRP or RP. So he is expected to transfer the business as is it is. So in operating a condition only. So in that condition, that will be actually regarded as a going concern, and that will fetch more value. So any further questions, sir?
May I come in? This is
Yeah, yeah.
Osim Maiti.
Yes, sir. Yes, sir. Go ahead, sir. Kuldeep ji, but prior to that, Kuldeep ji, do you have any further questions, sir?
Thank you, sir.
Okay, okay. So, Mehti sir, go ahead, sir.
Now, I want to tell you that regarding one liquidation case, that that company was under construction and it was idle for 10 years almost, and it is
Okay.
under liquidation.
Okay.
But that is sold as going concern. Liquidator has sold that as going concern. So
Yes, sir.
my point is, it is not necessary the company should be in operation, but that can be sold as a going concern.
Yes, so actually, wherever you expect ki going forward, the operating activity of the company that will either be actually continuous as it is, or that will resume. So there are no chances of liquidation, winding up of the company, dissolution of the company. So in that scenario, it will be regarded that the company is a going concern. Wherever actually the management expect either to run the business as it is, wherever it is in operating condition, or to resume the business activity. Supposing actually a business required additional investment of say 50 crore rupees to upgrade the technology, and new buyer is ready to actually invest 50 crore rupees in technological upgradation. So once that is done, the business of the corporate debtor will run as a going concern. So that is precisely the meaning. So whenever, in other words, whenever it is not expected that the company will be liquidated or wound up, or a dissolution, that will be under a dissolution process. So that is a going concern, sir.
And one more thing I want to add, in some cases where liquidating is difficult, like land is leased land and equipment is in different name, in that case, sometimes liquidator feel to sell it as a going concern. In that case, lease value is automatically transferred to the new purchaser. But if you liquidate it, then it will be difficult because lease cannot be transferred that way. So in some cases, company may not be operational. Maybe after that, that new purchaser will make building over there instead of factory. But transferring it has become difficult from lease land.
Very true,
In
sir.
that
So
case,
there are instances where actually there are a government undertaking, state government undertaking, that is for industrial industrialization. They provide the land on lease. Now, actually, there is no provision to transfer that lease. Actually, so as you told in liquidation, that transfer will be involved. But if you actually transfer the business as a going concern, so automatically the transfer of lease will take place. So that is what perhaps you want to explain. So that is actually depend upon the ground reality of each case. If land is precious and if the prospective buyer see the opportunity, naturally they would like to acquire it as a going concern. And they actually get the precious land in that bargain. So it may happen, sir, depending upon the ground reality of each case. That is what you wanted to highlight, Mathi sir. Any further?
yes, sir, exactly, sir. Okay.
So I hope there are no further query. So actually, this is a section 232, in subsection 2 of section 230, and a subsection 3 of section 230. So filing of compromise arrangement among the creditors and shareholder. So naturally, that is a very major event, and that will require the valuation. Then we have the section 230, 32, mergers and acquisition. So as we all are aware, for listed entity, the SEBI regulation will be applicable, and for unlisted entity or private company, the company's rule will be applicable. So there actually to determine the exchange ratio between the shareholder of two company, or in order to finalize the purchase consideration, a valuation will be needed. Now, section 281 1A, valuation of asset at the time of winding up of a company. So as you all are aware, presently there are three avenues, three opportunity, three situation under which a company can be liquidated or company can be wound up. So two are under the IBC, that is voluntary liquidation and a liquidation process. So two are under IBC and one is under the provisions of the Companies Act, and here that is winding up by the tribunal, winding up by the NCLT. So whenever actually the provisions under section 281 are invoked, so and a company is actually put to a winding up process, so their evaluation of assets will be required. So this is a liquidator appointed under the provisions of the Companies Act, not under the provisions of the IBC. Here we are talking about a liquidator appointed under the provisions of the Companies Act. And then Section 8, as we all are aware, Section 8 are non-profit enterprises, non-for-profit enterprises. Their evaluation of asset of a Section 8 company, when it is to be converted into other type of company, like from non-for-profit enterprise to for-profit enterprise. So there, whenever such eventualities are there, valuation will be needed. Section 39, prospectus and allotment of security rule. So their issue of share for a consideration other than cash. So their valuation will be required. Section 54 and a rule 8.6. So what I have done for better understanding, I have also quoted the relevant rules under which valuation is required, company's rule. And as we discussed, wherever it is rules, so that is applicable to the non-listed companies, to the private company. So section 54, a share capital rule. So fair value price justification for issue of short equity share to the employees of a company. Section 54, a valuation of intellectual property. As we all are aware, that is also a very important consideration. Intellectual property right, like a patent, copyright and all. So there actually, or the know-how acquired by the issue of short equity share, so that also need the valuation. IP, as we all are aware, a part of IPR, intellectual property right, and intellectual property right in turn are a part of the intangible asset. So wherever we are doing the value of IP, intellectual property, so we need to follow the guidance provided under valuation standard related to the intangible asset. So that is about the IP. Then actually a share capital and a debenture rule. So a share issue other than right and ESOP. So that is before pricing the issue. And then a share capital and a debenture rule. So determination of price of issue by unlisted entity when shares are issued to the employee trust. Many times actually ESOPs are first transferred to trust and from that it is granted to the employee. So there actually a valuation is required, and acceptance of deposit. So to determine that bonds or a debenture issued are secured, and a valuation of the asset provided as security will be required. So asset-based securities, in that case, valuation of assets will be required. So these are the scenario, these are the situation where a valuation will be required. So in short, under the Companies Act, these are the valuation cases, situation or activity. So for the purpose of issue of share for a consideration other than cash, issue of short equity share, issue of share including ESOP and right issue, a valuation of asset provided as security, a non-cash transaction involving director, compromise or arrangement among creditor or shareholder, a merger and amalgamation, acquisition of minority stake, and valuation of asset at the winding up of a company. So in short, these are the situation where we need the evaluation under the Companies Act. Now actually, mainly actually IPO, there are two types of transaction. Number one, primary transaction, and number two, secondary transaction. So whenever actually there is a fresh issue, so fresh issue that can be in the form of right issue or a bonus issue. I am talking about fresh issue of shares, fresh issue of a common shares or equity share. So that can either be issued through the right issue or bonus issue. That can be issued through the private placement. As we all are aware, actually there are many situations where the shares are issued to the qualified buyer, accredited investor, or venture capitalist, private equity. So there are many situations where shares are issued as per the condition finalized under the private placement. And then you have the preferential issue. So fresh issue, these are three avenues which is there. Now actually IT Act and provisions of the Companies Act, so there always be a certain contradiction. So that is actually I have highlighted here, I have tried to highlight here. So if we refer to section 56, in the recent past, as we all are aware, there are major changes in a rule 11 UA or a section 56 to 7B of the Income Tax Act. So a section 56 to 7B, as we all are aware, section 56 is related to income from other sources. Income from other sources. So there actually 56 to 7B of the Income Tax Act that provides for a taxation of the consideration received on issuance of certain shares at premium. So remember, under the IT Act, there is no issue when shares are issued at a fair value or at par value or face value or at discount. But when it is issued at a premium in excess of fair market value, so the provisions of section 56 of the Income Tax Act will be applicable. So prior to Finance Act of 2023, so a section 56 to 7B of the Income Tax Act that provided that where a company, not being a company in which a public are substantially interested, so that is a private company, receives in any previous year from any person being a resident. So here that was restricted prior to Finance Act of 2023. That was restricted to resident only. So that was not related to or applicable to the NRI or a foreign citizen. So here it was only resident. So that is any consideration for issue of share that exceed the face value of share, the aggregate consideration received for such share as exceed the fair market value shall be chargeable to income other we had income from other sources. So meaning thereby, wherever actually the shares are issued to a resident at more than the fair value, so that amount will be charged to income tax under the provisions of income from other sources. Now, Rule 11 UA that provides the formula for computation of fair market value of unquoted equity share for the purpose of section 56(2). So, a Finance Act of 23 has included the consideration received from non-resident also. So, now it is a resident and non-resident both. So, that is the major change which has happened through the Finance Act of 2023 for actually issuance of shares at premium, So if we analyze actually the section 56(7)(b) under Income Tax Act, this is a very important section. So fresh issue of shares by the company, actually what are the avenues available for fresh issue? So that we have seen either right issue or bonus issue, private placement or preferential issue. So a fresh issue at par or face value, there are no restriction or there are no issue. At premium, so when it is at a fair market value, again there are no restriction or no issue. But wherever actually the fresh issue of shares by a company at premium is above the fair market value, then that will be whatever is the excess consideration that will be charged to the income from other sources. That section 56 of Income Tax Act is related to income from other sources. And wherever it is at discount, so there are no issue under the Income Tax Act, but there are restriction under the provisions of Companies Act. So this summary will highlight actually wherever as a valuer, you will advise to your client for a fresh issue of share, particularly by the private company. So make them to issue either at the par or a face value, or wherever it is at premium, so that should be issued at fair market value, which is determined by the valuer. And if it is above fair market value, then whatever is the excess consideration, that will be charged to the income tax. So that is a very vital. And again, these are methods to determine the fair market value as per the Income Tax Act provision. So as we all are aware, securities will include not only the equity share, that will include the preferred share, that will include the fixed income security like bond, debenture, derivative. So all type of security, wherever it is listed, and those securities are transferred through market, so transaction price will be considered. And wherever the listed securities are transferred off market, means not through market but off market, then a traded price in the market, because these securities are listed, so naturally we will be able to determine the traded price of that particular security from the concerned stock exchange where that security is listed. So traded price will be considered. So that is related to the listed security. Unlisted security, that if that is equity, as we all are aware, security will comprise of many security, not only equity share. So if that unlisted security is equity, and that will be actually valued at net asset value of the company or NAV of the company. And in case of other security other than equity, so that will be a charge to income tax, or that will be valued at the estimated price as given by the valuer, So that is very important with distinction between listed securities and the unlisted security. Now again, to highlight actually a provision vis-a-vis the Companies Act and vis-a-vis Income Tax Act. So wherever there is a right issue, so if it is issued at par or a face value, so under Companies Act, there are no restriction, and under Income Tax Act, there are no restriction. But if it is at discount, so there are a certain restriction under the Companies Act relating to right issue, but under Income Tax Act, there are no specific restriction. And if it is at premium, so Companies Act, no restriction, but under Income Tax Act, the provisions of the section 56 to 7B will come into play. Provisions of section 56 to 7B will come into play. Similarly, the preferential issue, or the private placement. So if that is at par or a face value, so under Companies Act, issue price needs to be equal to the price determined by the registered valuer in asset class SFA. And Income Tax Act, there are no restriction, but a question will come how to deal where estimated price by RV is not equal to the par or a face value. So it may happen that actually the price determined by the valuer, that is either more or less than the par value. So in that scenario, this specific question will come, and we are not getting any specific guidance from the ITA or a CA, Companies Act, relating to this. At discount, so there are no restriction under both these act. And at premium, so issue price needs to be equal to price determined by the RVSFA. So if this condition is specified, then there are no issue under the Companies Act provision. But under income tax, the provisions of section 56(2)(5)(b) will come into play. So that is the right issue, because many times questions have been asked on this particular only valuation and taxability of the right issue, preferential issue, and a private placement. So that is actually highlighted here. And this is the gist of the provisions, because many times actually questions have been asked exactly which provision will be applicable. So transfer of share under section 50 CA, under section 56(2)(x) and rule 11 UA1. So these sections are of Income Tax Act. So a rule 11 UA, that is to understand the terms used in rule 11 UA. So if we actually have any confusion about the terminology used under rule 11 UA of the income tax rule, so we need to refer the meaning provided under rule 11 UA. Rule 11 UA 1 CA, Rule 11 UA 1 CA, that is evaluation of quoted security. Quoted security means listed security. Now, security will include equity, a fixed income security, financial derivative. All those will be covered under the definition of security. So wherever it is quoted, like a financial derivative. So as we all are aware, there are 4 types of contract under the financial derivative: the forward contract, future contract, option contract, and swap contract. So quoted out of that will be future and option. Future and option are quoted. So that in that case, but forward contract, that is a private contract. So that we may not be able to consider that as quoted contract. So rule 11 UA 1 CA, that is related to valuation of quoted security. Rule 11 UA 1 CB, that is related to valuation of unquoted equity share. So here it is other than equity share. And rule 11 CC, that is valuation of unquoted preference shares and other security. So that is actually the guideline. Moving forward, issue of shares. So a rule 11 UA 2A, a valuation principle of unquoted share issued of issues of share. So there are 5 methods, and these 5 methods are prescribed under the Finance Act of 2023. These 5 new methods, apart from 2 methods, these 5 new methods have been prescribed going by the recently amended provisions of Rule 11 UA, that is through Finance Act of 2023. And other method, so this cumulative convertible preference share, so Rule 11 UA 2B, validity period of valuation report of merchant tanker, that validity period is provided under this rule, and variation is permitted, that is known as safe harbor route. So provision related to that is 11 UA4. Now, actually, these are the summary of recent amendment. So, a rule 11 UA2A, fair market value of unquoted share. So, FMV of unquoted share, that is actually NAV needs to be provided by the auditor, and that is in both cases now, resident as well as non-resident. FMV of unquoted share, so that valuation report will be provided by the merchant banker, and that will be in both cases, resident as well as non-resident. A venture capital company specified firm, so that will again require a valuation. FMV of unquoted share, so that will be given by the merchant banker, and there are 5 new methods prescribed for that, and that is not required for resident, but these 5 methods that is are required in case of non-resident. So like that, actually, I have highlighted a summary of the recent, and these are the key highlights of changes under Rule 11 UA through the recent amendment. So in addition to the two method for evaluation of share, in addition to two methods of evaluation of share, a DCF and NAV method, so available to resident under Rule 11 UA, 5 more evaluation method have been made available for non-resident investor. So therefore, I have highlighted in previous slide, these 5 methods are not applicable to the resident. This is applicable to the non-resident. So these made available for non-resident investor. So in other words, for resident, we have the net asset value method and a DCF method, whereas in case of non-resident, we have these 5 methods. So these 5 methods are comparable a company multiple method, probability weighted expected return method, option pricing method, milestone analysis method, replacement cost method. So we are familiar with the concept of a replacement cost method and a comparable company method, a comparable company multiple method. Because comparable company multiple method, that is under the market approach. Replacement cost method, we know that that is under the cost approach. But these 3 new option pricing method for equity valuation. Option pricing method is for option contract normally, black and Scholes binomial method. But here we are talking about the evaluation of equity. And then we have the same method, black and Scholes and binomial. Mainly it is black and Scholes, so that will be applicable for evaluation of equity or evaluation of entire enterprise. So these 3, probability of weighted expected return method, option pricing method, milestone analysis method. So these 3 methods, you may find actually a new method. You may find that as a new method. So where any consideration is received for issue of share from any non-resident entity notified by the central government, price of the equity share corresponding to such consideration that may be taken as fair market value of equity share for a resident and non-resident investor subject to the following. So that is actually we need to comply with recent provision, and on a similar line, price matching for resident and non-resident investor would be available with reference to investment made by venture capital fund and the specified fund. So earlier there were a certain consideration for investment by the venture capital fund or the special fund, but now that is not there. And evaluation method for computing the fair market value of compulsorily convertible preference share have also been provided, and safe harbor 10% evaluation in a value has been provided. So these are the recent amendment. Now, actually, how to do actually wherever a transfer of jewelry by way of gift is involved, or archaeological collection, drawing, painting, sculpture, or any other work of art. So, wherever it is a transfer without consideration, so how to do a valuation of that? So, this is actually there are basically three methods, three alternative. So any of these will work. Number one, estimated to be the price at which such jewelry would fetch if sold in the open market on the valuation date. Number two, if purchased on the valuation date, invoice value of jewelry shall be the fair market value. So wherever it is purchased and transferred in the near future, so that actually whatever is the purchase consideration paid, that will be considered as the value, provided it is backed with a invoice, and that invoice also needs to be issued by the registered valuer. So in other words, if the invoice is not issued by registered dealer, so that will not be considered. And any other mode and the value of jewelry exceed 50,000 rupees, then assessee may obtain the report of registered valuer in respect of the price it would fetch if sold in the open market. So almost same conditions are there for archaeological collection, drawings, painting, sculpture, and any other work of art, wherever it is transferred as gift or without purchase consideration. Now, these are the five methods that I have highlighted here, which are the new method applicable to non-resident. So what is comparable company multiple method? We all know about that. Then a probability awaited expected return method. Actually a brief about that. Option pricing method. So how to do a valuation of equity going by option pricing method, that I have highlighted in a brief here. Similarly, the milestone analysis method. So a brief on that I have highlighted here, and a replacement cost method. So a brief on that I have highlighted here. So these are the five new methods which are prescribed for evaluation in case of non-resident going by the recent amendment. Now it is actually a two thing. Number one, it is more than 90 minutes. So if it is convenient to each one of you, we will have a small break of 7 minutes, and then we will continue in the remaining time. But prior to going into a break, any questions from your side? If any questions are there from your side on whatever we have completed so far, so questions are welcome.
So I would like to myself Progress Thakur.
Yeah,
I would
namaskar.
like to.
How are you?
Sir, how are you? How are you, sir? Fine. Sir.
I'm fine. Thank you.
How is your health?
Health is fine.
Okay, sir. Now I would like to ask regarding the difference of difference between the two valuers in IBC. How much
Okay.
percentage is permissible? It's a drastic difference is there. See, the concept of average is there, but there is a drastic difference.
Yes.
Suppose somebody is doing the valuation up to 40%, somebody is doing 80%, say 40 and 80. So there is a
Yes.
drastic difference.
Yes.
Because Supreme Court has given the judgment normally the 15% variation is permissible. 15% between two valuers, authentic valuers.
Okay.
So
So
any
actually that I understood your question. So that ambiguity was there earlier, but now within the regulation only, now regulations have been amended, and in regulation only you will get the guidance. So let me take you through that regulation. Just give me a minute. This is my PPT, and I will take you there at the concern. So probably that will give reply to your query, Kamlesh bhai. Just a minute. So here there is a provision, if you go through this. So here there is a I hope you are actually able to read this, what I am highlighting. If the two estimate of value in an asset class are significantly different, different. So this is a regulation 35 of CIRP regulation. So earlier, what is the meaning of significantly different? That was not provided in the regulation. But now regulation has been amended. So here actually it says where a significantly different or on a receipt of proposal to appoint a third registered valuer from the COC, the resolution professional may appoint a third registered valuer. So there is a provision for appointment of the third registered valuer. Now a significantly different, that means a difference of 25% in a liquidation value under asset class, and the same shall be calculated as L1 minus L2 divided by L1. So where L1 is the higher valuation of liquidation value and L2 is the lower valuation of the liquidation value. So I hope this will give a reply to your query,
Yeah,
Kamlesh
got it.
bhai. Any
25%
further?
is the limit.
Yes,
Yes.
and
No, no, okay.
25% in liquidation value, not in a fair value, because under CIRP, the valuers are appointed to measure or estimate or determine the fair value and liquidation value. So here it says liquidation value. So that you need to consider.
So anything about fair value, sir? Anything about fair value?
Fair value means if it is different, that will not be considered by the RP. Only when there is significantly a different liquidation value, then only third registered valuer will be appointed. Are you there, Kamlesh bhai? It seems you have lost the connectivity. Am I audible, Kamlesh bhai?
So one more thing I want to ask. You were talked about the going concern. Yeah, I am there.
Yeah.
No, I'm there. I can be sir, and myself is also.
Yes, you are audible. Go ahead. Yeah, go ahead.
I would like to again ask the question regarding the going concern. You told about the going concern. When going concern is having a good profit, say some restaurant chains are there, McDonald's and other things all. So they will not go for the liquidation. Why they are going for the liquidation? Only in the case when the debt is more than the asset value, or they will sell in the open market. What is your view?
Yes, yes. So your exact question, if I understand correctly, is
Why they will
when
go for
actually,
IBC?
yes, when there a purpose of CIRP is ownership transfer. So why we are determining the liquidation value? So that is your question.
Yeah, correct.
So
In
a
case of going concern
liquidation,
only.
actually, what is happening, Kamlesh bhai, in majority of the cases, company is going for the CIRP when actually the not only financial health but the assets operating capacity is also deteriorated. So in that connection, actually recovery, if they compare with the actually what COC purpose of IBC is not the recovery, but we all are aware ultimately that is what is seen by the committee of creditor. So if they compare with the going concern value, probably haircut will be in the range of 80%, 90%. So at least they are saying if this company will not survive, at least we will get the liquidation value. So that is my assessment. And so always they make comparison with the liquidation value. Okay, at least worst scenario is company will go in a liquidation and all the asset will be sold. So what we will actually realize as compared to non-realization of anything. So that is what
What is
actually.
my judgment is that when operating cost is much more than the profit earning, in
Yes.
that case only, like Air India and that other airlines company, etc., when operating cost is increasing drastically compared to their income, in a
Yes.
going concern,
Yes.
that thing will happen.
Yes. Very true.
Thanks a lot, sir.
Thank you. So any
Uh,
yeah, go ahead, sir.
yeah. Sir, may I ask one question?
Go ahead, sir.
Sir, may I ask you what's your take on liquidation value? How do you judge that?
See, a liquidation value, if you refer to the actually guidance provided under the international valuation standard. So this is the liquidation value. So amount that would be realized when an asset or group of asset are sold on a piecemeal basis. So when we are determining the market value, when we are determining the fair value, we are not assuming that assets of the corporate debtor that will be sold on a piecemeal basis. Piecemeal basis means it may happen that land and building separately, plant and machinery separately, furniture and fixture separately. If a company is doing in a multiple business at multiple location, so each of those location asset can be sold separately. So that is the primary condition. Asset or group of assets are sold on a piecemeal basis. So naturally, that will reduce the value as compared to a fair value of entire enterprise or market value of entire enterprise. That is number one. Number two, the liquidation value should take into account cost of getting the asset into sellable condition. So that we discussed. So in liquidation value, you will consider this to bring the asset into sellable condition and those of the disposal activity. So actually, you have a motor car, supposing 5 year old, and you have not used that motor car for 1 year because you were out of station. Now, to bring this motor car to a working condition or sellable condition, whatever cost is involved, that you will consider in the liquidation value. But that guidance is not provided when you are determining the market value and fair value. And this again very important. A liquidation value can be determined under two different premises: orderly transaction and forced transaction. Forced transaction means immediately you will actually sell that without having proper time for marketing. Whereas orderly transaction means you will have time for a proper marketing. So these two premise will also alter the liquidation value estimation. So I hope that
In that
is,
case, how much you are taking the percentage for liquidation value? Means
sir,
40%,
that
50%.
percentage, if it is so much, because see, in valuation, nothing can be generalized, you will appreciate that. And
No,
that
your
will
take on
depend.
this. I mean, your take on this.
Sir, means I cannot say without going through the ground reality. Each company, each asset class will have a different ground reality, and that is the judgment of the valuer. So, based on information document, based on the physical inspection of the asset, the valuer will take its own judgment, sir. I cannot say you reduce just 25%, 30%, and you will get the liquidation value. No, it is not so simple, sir.
Yeah.
So that is
Sir,
my understanding, sir.
sir,
Yeah.
I have one question
Go ahead, sir.
regarding cost of liquidation.
Yeah.
How do I how do you determine the cost of liquidation? Suppose it is you are the valuer.
Sir,
How do you determine the cost of liquidation?
where I will actually require to where I am required to determine the cost of liquidation. Nowhere it is there, sir.
No, that is realizable value means cost. You have to find the realizable value.
Realizable value of the assets, sir, not liquidation value. Liquidation cost. Liquidation cost is for entire process. That is altogether different thing. Whereas you are actually estimating for the asset. So a plant and machinery. So you will do the inspection, physical inspection of the plant and machinery. Supposing it is land and building. So building, if white force is not there, it requires some repairs to bring it to sellable condition. You will very well estimate that, sir. You will be in a position to estimate that based on your physical inspection of the property. So liquidation process cost and a cost involved in bringing back the asset in sellable condition. These two are different things, sir.
So as per you, liquidation cost should not be deducted from the realizable value to get
Where
the
it
net
is
realizable value.
provided, yeah, sir, you show me the provision where there is
No, no.
actually.
In the provision, realizable value is not defined. I'm just
No,
asking you.
realizable value very much defined here, sir. See, again, I will highlight the amount that would be realized, and liquidation value should take into account the cost of getting the asset into sellable condition, number one. Number two, as well as those of the disposal activity. So these two are the costs which you
No,
need
no,
to
sir,
consider.
cost of disposal activity includes cost of advertisement, cost of the liquidator, cost of all these things. No, sir.
No. Cost of disposal, supposing there is plant and machinery, you can visualize a factory. There is a big factory, and all the plant and machinery naturally that would have been erected on a civil structure, and you are selling that machinery on supposing as is varies basis, है ना, sir? So whatever actually the cost is involved in dismantling those machinery, that you will consider dismantling cost. You are not supposed to consider the advertised cost, because advertised cost is for actually invitation of claim. So that is composite cost, sir. That is not related to sale of that. But if any auction, nowadays it is electronic auction. So even actually many time advertised cost will be very, very minimal, sir.
Okay, sir.
And you can always take estimate. If you are so worried about the advertised cost, you can always take the estimate of that in writing from the liquidator. You give me the estimated cost, and that you may consider. But advertisement cost for disposal of asset will be very, very minimal, sir, according to me.
Sir, regarding that, I had a talk with the liquidator. He said my security cost is this, my cost is this, and you have to consider that also, cost of liquidation.
I
So
am not actually, that is not my understanding,
they
sir.
are asking cost of security, my security payment to be done, all these things, my asset value should be more than that. These are the all things comes up.
Sir,
That's why
now
I
if you see the logically, so when you are selling the machine, so you are determining the value of that machine. Okay, sir? How
sir.
actually other expenses, because that will reduce the realizable value of the machine. Supposing a realizable value of the machine is 10 crore rupees, and cost of disposal and bringing it that to the workable condition is 1 crore. So 9 crore rupees is the net realizable value. Now
Right,
here
right,
you cannot reduce the other cost, sir. That is my understanding.
Okay, sir. Thank
Security
you.
and all is not related to this, sir. The security cost is not asset specific. That is for the entire business, sir. So that my understanding is different, sir.
Sir, could
Suppose a company is left with 4 vehicles, nothing is there, but he has kept one security for that 4 vehicle. And
Building must be there, sir. Some erection.
as per my understanding, whatever comes in your pocket is realizable value. So if you have to
Whatever
deduct all the
pocket means,
costs.
in your pocket will come more when you are selling that machine. And now that we will actually not discuss further. I have actually conveyed my understanding. Your view may be different, sir. We will not go into
Yes.
further detail of that, sir.
Oh, okay, thank you. Thank you. Okay.
Thank you. So any
Sir,
further question? Yeah, go ahead,
yes,
sir.
sir, I have one question. Could you please explain the terminology as it is varies basis?
So as is various basis, I gave you the example, sir. Supposing there is a big machinery, and that big machinery naturally that have been commissioned, and commissioning will require actually tightening that to the civil structure. Now, when you are selling that, I will sell that as it is various basis. Now that big machinery, erection actually or decommissioning, supposing you can visualize a chemical factory. So decommissioning will actually first require to make that machinery or storage tank chemical free. So that will also involve the cost. Then a de-erection from its root, from its foundation. So that will also require certain cost. So you are saying, "Okay, I will not decommission this machinery. Prospective buyer will come and decommission the machinery." So naturally, when he is making a quote, he will consider the cost involved in decommissioning of the machine. So accordingly, he will give his quote. So that is my understanding, sir.
Okay.
Any further query? Now, as I can see, we have only 5 minutes left. So quickly, actually, we will not take the break. And thank you for making this interactive. And whatever is the remaining, I want to highlight that I will highlight in the remaining time. So a legal framework, that is a SEBI regulation. So this is related to SEBI. So again, we are talking about the consolidated term of security, and that actually we have the Security Contract Regulation Act of 1956 and Depositories Act of 1996. So under a Security Contract Regulation Act, we have the Security Contract Regulation Rules of 1957, and then a SEBI Depositories and Participant Regulation 2018. So whenever we do the evaluation under a SEBI regulation, we need to keep this legal framework in consideration. And a SEBI, actually, as you all are aware, legal framework is very wide. So if we need to do valuation, we are required to go through the circular, master circular, general order, guideline, rules, and regulation. So that is under, actually, these are issued under a SEBI Act of 1992. And these are the provision where actually the evaluation is required under the SEBI regulation. So a SEBI listing obligation and a disclosure requirement. Then we have a SEBI substantial acquisition of shares and takeover. These takeover regulations are very important. Their evaluation is required. Issue of capital and a disclosure requirement, ICDR regulation, their evaluation is required. Then a SEBI Infrastructure Investment Trust regulation, SEBI Real Estate Investment Trust regulation. So IIT and REIT evaluation is required. AIF, again, a very important. That is AIF. Actually, I would like to bring to your notice what is AIF. So I have highlighted here category 1, category 2, and category 3. As you all are aware, fund manager of AIF, they have a very huge corpus, and they mainly have close-ended fund and open-ended and or close-ended fund. So either they will have a close-ended fund or open-ended fund. And this circular is the a very recent circular issued on 21st of June 2023, standardized approach to valuation of investment portfolio of AIF. So here, actually, earlier, actually, there was no standardization. Now it is a standardization. Now it is a standardized. And going by that, actually, I would like to highlight this. So eligibility criteria for independent valuer. So in terms of regulation 23(4), manager shall ensure that the AIF appoints an independent valuer. Now, who can be the independent valuer? Earlier, that was not specified. So through this circular, it is specified. So which satisfies the criteria specified SEBI from time to time. So a following is specified. So now actually they have specified. So independent valuer shall not be an associate manager of a sponsor or trustee of the AIF, and independent valuer shall have at least 3 years of experience in evaluation of unlisted securities, and the independent valuer shall fulfill one of the following criteria. So here, actually, independent valuer is a valuer registered with the IBBI. So now IBBI registered a valuer, they have the opportunity to make valuation of AIF. So AIF valuation, that is required on a recurring basis. So whenever it is a open-ended fund, so every month valuation will be required. And whenever it is a close-ended fund, so a valuation will be required on a quarterly basis. So if you have any networking with the fund manager of the AIF, Alternate Investment Fund, probably you will get the most high value and lucrative assignment. So explore possibility in that direction. And with that, as I can see, it is already 12 p.m. So our time we on the verge of completion. Without break, we have continued this session for 2 hours. So I express my sincere thanks for your attention throughout this session and making it the most interactive session. So before we finally end this session, if any further questions are there, so questions are welcome. Thank you, Vipulji, for your kind words, sir. So any questions from your side on whatever we covered?
Is it
Thank you,
possible to
sir.
share the presentation?
Yeah, presentation I will forward to the organizer of this event, and in turn you will get from them, sir. Definitely I will forward to the organizer of this event, sir. And
Sir,
I'll express. Yeah, go ahead, sir.
the methodology which you are told is very much helpful and nicely presented, sir. Thank you very much for the same.
Thank you, sir. Thank you very much, sir.
Hello.
Go ahead, sir. Rao, sir.
Six months. How to take the valuation?
Rao, sir, you are not audible, sir. May I request, please repeat your question, sir?
I'm just asking you, sir. First of all, thanks for your detailed presentation.
Thank
I'm
you,
just
sir. Thank
asking
you.
clarification whether I missed it for the CCPS valuation also. Convertible preference shares.
Yes, sir. Yes, sir. So that guidelines are there in Finance Act 2023, recently amended. So you may go through, and in my PPT also I have covered that, sir.
That's great. Thank you, sir.
I will forward the PPT through organizer of this event, sir.
So nice of you. Thank you, sir. Thank you. So nice of you.
Thank you, sir. Thank you. So I thank each one of you for your kind words to the chat box, and that will really provide me the encouragement for a further improvement. And if you no further question, in that case, we will end the session here. So Kajal madam, are you there?
Yes. Yes, sir.
Yes, sir.
I am here, sir.
Yes, sir. Yes, sir.
So we come to the end of this CEP. Thank you, Chatwani sir, for very
Thank you.
nice and very elaborate lecture.
Thank you, sir.
All doubts were cleared and it was a very interactive section. Thank you very much. Thank you, participants, for your participation. Please share your feedback. Thank you very much, Kajal. Thank you.
Thank you, sir. Thank you all.
Thanks, Yogesh bhai.